On your screen, you'll see an investment disclaimer for you to read through. Highlights are that we don't offer advice. Nothing you hear tonight is a recommendation or endorsement. And if you're not sure about the suitability of investment, you should seek qualified, independent financial advice. So that's it for housekeeping. On with the show. I'll kick you off with a quick look at the life cycle of the company. And here, what I want to do is just to explore the different stages of a business and also how you can get involved as a retail investor. Yeah, again, a quick investment disclaimer here. It's very important that you do read them though. So the value investments can go down as well as up. You may get back less than you originally invested. Now, we don't offer advice, so it's important you understand the risks. If you're not sure, please consult a suitably qualified financial advisor. So past performance is not a guide to future performance. Some investments do need to be held for the long term. Forecasts aren't a reliable guide to future performance. So thank you very much for just bearing with me those disclaimers. But so on to the show. So startups, we have the idea of a new business, maybe one or two people in their garage. They've got some bright idea and they're thinking, okay, what do we need to do? Probably we need to hire some people, maybe to do some computer coding. We're gonna have to spend some money potentially on product samples. We'll certainly need to spend some money to improve our marketing and distribution. So of course, all that involves getting money. So where do they get these funds? So potential sources of funding for startups include friends and family, angel investors, venture capitalists, private equity, and some other institutional investors, but you probably won't see banks here. I think they would think that startups are probably too risky for them to get involved. But this part of the market is called unquoted or unlisted. So a company doesn't have its shares on a stock market that you and I could buy, but that doesn't mean to say we can't get involved. So there's various ways that as a retail investor can access this space. One is through venture capital trusts, such as a well-known product in that area is Octopus Titan. Here you get tax breaks, you get 30% tax relief up front, and then you get tax benefits where if you hold it for 5 years or more. There's enterprise investment schemes, and increasingly investment trusts such as Scottish Mortgage and 3i. These are sort of well-known names now amongst retail investors, and one of the key reasons why they're looking more in this space is that companies are simply staying private for longer. Private businesses are finding that there's a bigger pool of people interested in providing finance. There isn't this rush to get onto the stock market, and so as if you're a fund manager for an investment trust, for example, you want to look at this space because these are perhaps opportunities that could deliver you good returns into the future. And we are seeing that with several investment trusts making plans to do more in this space. So I'll give you a couple of examples. The Baillie Gifford UK Growth Trust recently went to shareholders and said it'd like to invest up to 10% of its assets in private companies. So this is in its situation is looking at businesses worth 500 million or more. So not really baby startup stuff here, but perhaps on the sort of the later stage side of things in that area of unquoted businesses. And Fidelity China Special Situations, they're saying the same thing. They're seeing lots more companies staying private for longer. They're already active in this area, but they want to go from 10% to 15% of NAV to be able to go in this area. And they're particularly saying in China, there's lots of opportunities for private businesses that they can invest in. If you want some further proof that the way investors are thinking is changing, is that look at what BlackRock's up to. Their portfolio advisory business has been talking for a while now that the old model, when you're building an investment portfolio, of having 60% of it in equities and 40% of it in bonds, perhaps is a bit outdated. And they were suggesting perhaps we go for 50% equities, 30% bonds, and that remaining 20% to go into unlisted assets. So this really is a very, very sort of growing important part of the market for investors. In Shares Magazine over the summer, we had a look at this space, and if you just exclude all the private equity trusts, there's 22 investment trusts on the UK market that give you exposure both to unquoted stocks as well as quoted equity. So there is a lot of choice for investors in this area. Now, it's not straightforward as like find an interesting private company, invest in it. There are some really important risks to consider here. One is liquidity. So if you were a fund manager and you had a stake in a private business, and let's say you either want to sell it, you want to take some money, take some profit, or you think I just don't like it anymore. It can be quite hard to sell them because if you a company on the stock market, you can trade it freely, and other investors will be there freely to buy it. But with an unquoted business, you have to go out and find a buyer, and it can be much harder to do. Of course, they're difficult to value as well, again, because they don't have that sort of real-time valuation that you get with quoted businesses on the stock market. So poor old Neil Woodford encountered some of these problems with his income fund, where they had lots of investor redemptions asking for their money back. So he had to go and find some cash to pay them back. So he was selling holdings in the most liquid stuff, for example, the things that are on the stock market, and that meant the proportion of his unquoted holdings was getting bigger. And then it got to the stage we had to suspend the fund trying to find a buyer for these assets. Once you've established yourself, you've got some funding, you're perhaps you're seeing an increase in revenue generation. The next stage might be to think, well, do I sell this business to someone, or do I go ahead and float it on the stock market? So there's 3 reasons why someone might want to IPO. And for those who are watching who perhaps don't know what IPO stands for, it's initial public offering. It's the first chance that a member of the public can actually directly own shares in this business. So a company would float on the stock market to access the capital market. So this is to access a much bigger pool of investors that it might have reached in the past, because it can issue shares in exchange for cash and use that for acquisitions, or to perhaps invest in business or invest in new technology and so on. So it's incredibly important way, important decision for companies to come onto the market to access these bigger pool of investors. Of course, it can also raise the profile. I certainly know, speaking to various companies over the years, that they've said, well, when we became a listed company, we actually found it easier to bid for contracts, because the people we were hoping to work for could now see that our financial accounts were in the public domain, that everything that we did was monitored by investors, and we had to regularly report to things. And just generally, from a consumer point of view, the brand is probably being written about more in the papers, and it really does. There is lots of proof that it does raise a profile. And then perhaps the third reason to float on the stock market would be to provide an exit for an existing investor. So that might be one of those venture capital companies or one of those private equity companies. They would sell a big chunk at the IPO, and then over the next couple of years, they probably sell down the rest of their holding on the market. Once someone is on the stock market, there are various options, again, where they can take themselves. So they can move from a sort of a more junior market to a high profile. So for example, they might go from AIM to the main market in London, or they might add another listing in another stock market. So we sometimes see this with healthcare, pharmaceutical, biotech companies that like to add a listing in the US alongside one that they've already got in the UK. That's because they probably take the view that US companies might be sort of valued on a higher multiple, so they could be worth more. But there is also perhaps another area you want to consider here, is that certainly in the natural resources space, you've got lots of companies who might have been in Australia or the Toronto stock market. They might have simply exhausted the amount of people that are willing to support them with fundraisers. And so they need to go to another geographical area, another stock market in which to start fresh selling their story. And sometimes this isn't always a good thing, because you have to question why, if you've already got a geographical area that's suddenly bored of supporting them, is there something wrong there? So I'll just give you a quick few examples before I hand over to our 3 fund managers tonight. So 2 great examples of companies that have joined the stock market with the intention of growing through acquisition are Restore and Keyword Studios. Now, Restore used to be called Mavinwood. You can see the first few years of its life in the stock market did very well. Then it sort of got into a lot of problems, changed its name to Restore, decided to focus on document management area, and shareholders have been very supportive since then, constantly agreeing to buy more shares to give the company money to go off and make acquisitions. And Keyword Studio, well, this from the start was going out raising money in the computer games area. I remember talking to them when they first joined the stock market, and they were saying that you might think that computer games is quite an easy area to understand, but there's such specialist skills in so many different areas. And they were talking to me about an example that if you made a computer game and then you sell it in Germany, well, there's some rules there. You're not allowed to have blood on a character to be red. It's got to be green. So I thought it was quite interesting that they need to know all these cultural differences and stuff. And since then, they've built up this incredible business. And it's a perfect example of how someone's used a stock market listing very, very effectively. So Strix, private equity company. So it was a private equity business was liquidating its portfolio, and Strix was the last one left in it. This is like Kettle Control Systems. So it floated on the market at quite a cheap valuation. I think the private equity business just wanted to sort of clean up and just go away. It took a couple of years, but it's shown it's really caught the investors' imagination in a couple of last few years. You can see by the chart. And Domino's Pizza and Petra Diamonds, they've both moved from AIM to the main market about 10 or so years ago. And they did that to reach a much bigger pool of investors. I think probably a decade ago, AIM had this sort of reputation that, and certainly a lot of people didn't want to touch it. Lots of fund managers didn't want to look at it, but I think it's more accepted these days. And just finally, Pure Gold is a great example of a secondary listing where, for years, I think it was listed in Toronto. If you look between 2016 and 2020 on that chart, you show the share price literally has done nothing. So in 2020, it came onto the London market, and it went absolutely bananas for a while. But more recently, it's the share price has come off a little bit, and that's kind of to do with the gold price. But it does show you that sometimes a secondary listing can be quite powerful. So that's all from me now. I just wanted to sort of set the tone.